In this topic, we are going to talk about cost of capital, cost of capital, cost of capital. And this topic is very essential because it helps us how much we should pay or how much it costs us to use any form of capital. Now, in the former lesson on business valuation, we spoke about three main forms of capital or three main sources of funds in the capital market. So we spoke about how we value debt or bonds, how we value shares, and in shares, we divided them into two, how to value ordinary shares and how to value preference shares. Okay. So in cost of capital, we are going to talk about how much it costs us to use those forms of capital. So if you are using debt, how much will it cost you to use the debt? If you are using equity, how much will it cost you to use equity? If you are using preference shares, how much does it cost you to use preference shares? These things are very important because as a finance manager of a company, if you are going to look for several sources of funds, you must be mindful about the cost of those funds, such that you know that, okay, if I combine 50% of my total capital structure for equity, 10% for debt, and 40% for preference shares, this is how much it will cost me. All right. So we must know the cost of the various sources of capital so that it will help us in making capital decisions, as in where to look for money to finance our business. So cost of capital is simply the return providers of capital demand when they provide capital to a business. All right. So cost of capital is, so when you see anything like preference shareholders are requiring 5% on their investment, this 5% they are requiring is called cost of preference shares. Okay. If equity people require 10% on their investment, equity people, ordinary shares, they require 10% of their investment. This one is called cost of equity. And then if bondholders are requiring, let's say, 10% on their investment, we call it cost of debt. So we are going to talk about the various costs of, the cost of the various sources of funds. Now, as we mentioned, providers of capital can either provide equity or shares as against debt. So let's talk about cost of debt. Cost of debt. Cost of debt. So cost of debt is the required rate of return investment of lenders, is the required rate of return on investment of lenders of a company, right? So anytime people lend money to you, the rate of return they require is called cost of debt. Cost of debt, all right? The rate of return they require is called cost of debt. Or the yield they require on their investment is called cost of debt. So technically, cost of debt is synonymous to yield to maturity. Cost of debt, it is synonymous to yield to maturity, all right? Cost of debt is the same as yield to maturity. The yield that investors will require on their investment. So for instance, if I go and buy a bond, the coupon interest rate can be 10%. However, if a normal investor will require 20% on a similar investment in the market, it means that the cost of debt will be that rate. So cost of debt necessarily is not the same as coupon interest rate. Coupon interest rate is what the firm or the issuer wishes to give. But the cost of debt or yield to maturity is what any reasonable investor will require on similar investment if that investment was sold on the market, okay, or at an arm's length transaction. So cost of debt is synonymous to yield to what? Maturity. So how do we find cost of debt? Very simple. Let me show you. So we are going to talk about cost of debt for zero coupon bonds, and we talk about cost of debt for coupon bonds. So let's start cost of debt. So let's start with cost of debt for zero coupon bonds. Cost of debt for zero coupon bonds. Now remember that for zero coupon bonds, okay, for zero coupon bonds, remember the price of a zero coupon bond is the face value for zero coupon bonds. Okay, zero coupon bond, the face value over 1 plus the yield to maturity raised to the power n. And I've explained to you that yield to maturity is the same as cost of debt. So I can say 1 plus cost of debt raised to the power n. Now, this simply means that if I want to find the cost of debt, I have to make cost of debt the subject. All right, I have to make cost of debt what? The subject. So we do cross multiplication. This becomes 1 plus KD raised to the power n is equal to face value over price. So we are looking for this. So we take the nth root of both sides. So this will cancel this. We have 1 plus KD is equal to the nth root into bracket, sorry, the nth root of face value over price. So eventually, the cost of debt will be equal to the nth root of face value over price, everything minus 1. So this is the final formula. That is the final formula. Nobody will ask you to derive the formula. Just know the final formula, that's all. Or if you don't understand the formula, they give you a question, put everything in and find KD. All right. However, you can find KD, we don't have a problem. All right. However, we can find KD, we don't have a problem. Let's look at this question. So let's look at this question. This question says that assume Basket Wonders has $1,000 par value, zero coupon bonds outstanding. BW bonds are currently trading at 385.54. So here, the par value is 1,000. But they are currently selling at a price of 385. So the price is 385. .54, because the question says they are currently trading at, or they are currently selling at this with 10 years to maturity. So N is equal to 10. And please always note that in business, in security valuation, as well as cost of capital, N is always number of years to maturity. So if we saw the 10, if we saw, please, the par value is 1,000, it's not 100. Look at the question. Somebody wrote 1,000, I don't know why, but it's 100. It's not, it's 1,000, not 100. Okay, so Here, they are currently trading at 385.54. They are currently trading at 385. So that is the current price, 385.54. With 10 years to maturity. Now, I told you that N is 10 years, N is number of years to maturity. So if the bond was issued, let's say 2 years ago, for 10 years, as at now, the number of years to maturity would have been 8, not 10. We did something similar when we were doing valuation of securities. And as I said, FM is not difficult. These are some of the simple tricks that they can use. The formula always remains the same. Just that you must know some of these simple. Okay. So currently, the number of years to maturity is 10. The tax bracket is 40. Estimate the cost of debt. Now look at it carefully. So we know that the price is 385.54. The power value is 1,000 over 1 plus. We are looking for cost of equity we don't know. Raised to the power 10 years. So we are looking for this. We don't know. I'll talk about the tax rates later, but that's what we are looking for. We are looking for cost of equity that we don't know. So that's what happens. You do whatever to find this, to find the cost of equity. The cost of equity is actually this. Sorry, cost of debt. I'm sorry, cost of debt. You get 0.1 as an answer. All right, I'll talk about this second part, which is the tax. I'll talk about it soon. But the cost of debt is 0.1. So whatever you do to get the KD, why did I write cost of equity? It's cost of debt. Sorry about, let's make that correction. Cost of debt, not cost of equity, sorry. So whatever I'll do to get this cost of debt is my own mathematical gimmicks. That was why I was trying to give you guys a formula to get it straightforward. Otherwise, making KD a subject may be a little difficult. Okay. That's why I was trying to give you guys a certain formula, a certain simple way to get it. So you have to make KD the subject and get it. But let's apply my formula and see. So let's go to my formula. I gave you this formula. So here the KD will be that. So N is 10. Remember, N is 10. Face value is 1,000. Price is 385.54. So the KD will be the 10th root. Look at where I'm writing the 10. 10th root. Of 1,000 over 385.54, all minus 1. Now on your calculator, 10th root does not mean 10 root. They are two different things. 10 root 5 is different from the 10th root of 5. They are two different things. So on your calculator, let me show you how to punch that. So on your calculator, you press shift, like shift. You press shift and X raised to the power box. So you press shift and X raised to the power box. Shift and X raised to the power box like this. When you do that, it will open something like this, a square here and a square here. Now this square, you put in 10. And this bigger square, you put in 1,000 divided by 385.54. Those of you who have been able to do a punch, and let me see, what do you get for everything? So the smaller box, you put in 10. After that, you use the replay keys, the arrow keys. You press the forward one, it will get into the bigger box. In the bigger box, you type in 1,000 divided by 385.54. So when you punch everything, what do you get? Don't subtract the 1 yet too. Don't subtract the 1 yet. Okay. People are saying 1.1. Good. That's what I want to see. Okay. So everything here is 1.1. So the answer -1, you get what? 0.1. That's how you punch the 10th root of something. 10th root. That's how we punch 10th root. So don't go and punch at 10 root something. No. Another way is that you could have just done face value over price raised to the power 1 over n minus 1. So actually the 10th root of something is like raising that thing to the power n, like 1 over n, sorry. So this way too, you can punch like into brackets and you get the same thing. You get the same thing. For those of you who have calculator, you can open brackets, okay? When you open the bracket, you have a calculator. You can open brackets like this. When you open bracket, you punch this one, this over, like that fraction thing. Then when you punch the fraction thing, it will be like this on your calculator. So here you write in the 1,000 face value, then the 385.54. You use your arrow key. So you point the first one here, you use the down arrow key, come down and point the second one. Then when you are done, you close the bracket. So like you now use the arrow key to go forward. Go forward and you leave the fraction, then you close the bracket. Then you now go and type raised to the power, x raised to the power box. Okay, x raised to the power box. You type that thing. Once you type it, it will look something like this. And then when something like this occurs, type again this particular thing, like the fraction thing, all right? So when you type the fraction thing, it will now look like this again. So in here, you type 1. Use the arrow key to come down. You type 10. So when you punch equal to, you get the same 1.1. But it's a long approach for me. Why don't you just do the 10th root? Okay, that one is simple. But this and the 10th root, you get the same answer. Okay. So when you get the video, you can watch the calculator, right? Even in financial management, when we are teaching you, we assume that you know calculator, but I'm even taking the time to teach you calculator. We assume you know how to punch. So that is that. Now, anytime you compute cost of debt, the raw one, like this one, the one we computed, the 0.1. So that cost of debt is called before tax cost of debt. Okay, the raw cost of debt is called before tax cost of debt. So the KD is called before tax cost of debt. Now, what I want you to know is that debt brings debt. Debt brings something we call tax benefit. In accounting, okay, we have profit before interest and tax. Then we have interest payment, okay. So if the profit was, let's say 500, interest is 100, your profit before tax will be 400. And let's say tax is 10%. So the tax will be 40 cedis. Imagine a case where there was no interest. It will be profit before tax, which is 500. Then tax 10%, which will be what? 50. So you see that the tax will be high. Look at the tax here, 50, and the tax here is 40. So anytime there is interest, okay, it reduces our tax burden. So we call it the tax benefit of debt. The tax benefit of debt is that always when there is interest, interest will reduce our tax burden. Because look at when we have interest, look at the tax we are paying, 40 cedis. When there's no interest, we pay tax of 50 cedis. So always tax always reduces, debt always reduces our tax burden. And the debt also has a certain cost. So always the final cost of debt, we have to net off the tax benefit from it. We don't have to charge everything fully because the cost of debt gives us a certain tax benefit. So the final cost of debt will be something we call after-tax cost of debt. Call it after-tax cost of debt. And it's simply, so we call it KI. And it's simply the cost of debt into bracket 1 minus the tax rate. Cost of debt into bracket 1 minus the tax rate. So anytime we are doing cost of debt, we are concerned with the after-tax cost of debt. Because even though debt is bringing us a cost, it's also bringing us a benefit. So we have to net it off. All right. So in this question, the cost of debt was 0.1 and the tax rate was 40%, right? So the final cost of debt, KI, the one after tax, will be 0.06 or 6%. And normally that is what we want. The final cost of debt should be after tax cost of debt. So after computing the cost of debt, you have to net off the tax from it because it brings us benefits. So out of the 10% cost of debt, 4% of it is a benefit. We have to net it off. Then we get 40% of 10%. 40% of 10% is like 4%. So then eventually you get 6%. Out of the 10%, 4% of it is a benefit. So we have to net it off like what we've done. Okay. So that is how we find the cost of debt for zero coupon bonds. Now let's talk about cost of debt for, it is not in your slides, but I need to teach you because it's part of your course outline. So cost of debt for coupon bonds. What we did was cost of debt for zero coupon bonds. Therefore, this formula, this particular formula, this one, is the cost of debt for zero coupon bonds. So if you want the cost of debt for coupon bonds themselves, the one that has this thing, all right? There's a formula which have been developed by finance experts. And they say that if you want to find the cost of debt for coupon bonds, it will be coupon interest. It will be coupon interest, as in the coupon interest payment. Plus par value plus par value minus price divided by number of years to maturity all over 0.6 times the price plus 0.4 times the par value. Some people too, they don't want to use 0.6 and 0.4. Some people, so other books also say that coupon interest payment plus par value minus price over n divided by price plus par value over 2. When you say something is over 2, it's like saying 0.5 price, 0.5 par. So some books, they assign equal weights to price and par as a denominator. When you say this plus this divided by 2, it simply means 0.5 of this and half of this and half of this, something like that. But some books rather use 0.6 price and 0.4 par. But for me, I would prefer this one. I would prefer this. But however, later in life, when you are reading financial management books and they write it like this, it is not wrong. I mean, I'm talking about the denominator. Some will use 0.6 price plus 0.4 par. Some will use par plus price divided by 2. You should get approximately the same answer. But for the purpose of consistency, I would prefer you use the first one so that all of us. So let's intentionally pick a question we've done earlier. All right, let's intentionally pick a bond question that we did earlier. And let's see whether we can get the answer. So this particular bond question, we've done it earlier. We had, let's write them down. We had the price to be 955.606. We've done this earlier, all right? And then the par, I think the par value of this question, we found the price of a bond. I think the par value was 1,000. Par value, it was 1,000. And the question was 6 years, but because it was semi-annual, it became 12. It was 6 times 2, those of you remember, 6 times. Because it's semi-annual, the n became 12. Because 6 times. And then the yield to maturity was 26%. But because it's semi-annual, then it became 13%. But that is what we are going to look for at the question. That's what we are going to look for, right? That's what we are going to look for, the yield to maturity or the cost of debt. So n is 12. And then the coupon interest payment, this question, we've done it. This one, we rather found the price, but let's assume that the price has been given to you. The par value has been given, the n has been given, and then the coupon interest payment was 122.5. If you remember, the coupon interest payment was 122.5. Here. Let's use the interpolation formula to get the, let's see whether we can get the yield to maturity of 13%. Let's see if we can get the cost of debt. Okay, let's see whether we can get it using our formula that we have. Okay, so let's go there. So the formula, cost of debt is coupon interest. Coupon interest payment was 122.5. So the coupon interest payment plus into bracket, the par was 1,000. The par was 1,000. The price of that bond was 955,606. The number of years to maturity is 12. It was 6 years, but because it is semi-annual. So please, those semi-annual and monthly and those things, they can show up anywhere. They can show up in time value of money. They can show up in bond valuation. They can show up in cost of capital. You have to pay attention to the question. The issue of compounding period can show up anywhere. All right. So all divided by 0.6 times the price, which is 955.606, plus 0.4 times the par 1,000. Okay. So the calculators, can you point and let's see. I think I had a numerator to be 126.1995. And my denominator, let me see. I had my denominator to be 973.37. So you get something like 0.1296, which is approximately 0.13, like 13%. Those of you remember the rate, the yield to maturity or cost of debt was 26% for a year. But because we brought it to semi-annual, it became 13%. So these calculations we are doing everything in semi-annual. That's why we are getting the 13%. All right. So you see, we've gotten the answer. So that's how we find cost of debt. All right. That's how we find cost of debt. Okay, let's take an example. Let's take like a fully fledged example. I think to make it clear to all of us. All right. Let's take a full fledged example. Suppose you want to issue a 10-year bond. Suppose you want to issue a 10-year bond. At a coupon interest rate of 10% annually. The par value is 1,000 cedis, but similar bonds are selling on the market at 875 cedis. What is the cost of debt? And the after-tax cost of debt. If tax rate is 30%. So let's write this question now quickly. If tax rate is 30%. If tax rate is 30%. If tax rate is 30%. Yeah, somebody typed here, how did I get the numerator? Okay. Oh, the numerator, I did the, board mass. You have to do brackets of division. So board mass, you do 1,000 minus 955.606. That's the brackets. The answer you get, you divide it by 12. That's the division. So board mass, brackets of division. So you do whatever is in the brackets. The answer you get, you divide it by 12. Then you find, then whatever you get, you now add it to 122.5. That's board mass. So brackets of division, multiply, addition, those things. Yeah. So that's board mass. Okay. So the question is annually. So it means that I don't have to convert the coupon interest to anything. If the question was semi-annual, it means I'll divide the coupon interest rate by 2. All right. If the question was quarterly, I'll divide the coupon interest rate by 4. But here I don't need to do that because it's annually, right? So it means that the coupon payment is equal to 10% times 1,000. And that is 100 cedis. Okay. Number of years to maturity. The question says 10-year bond. So 10. Par value is 100. Oh, sorry, 1,000. And then the question says that similar bonds are currently selling. So the price is 875. So let's find the cost of debt. The cost of debt, remember, is coupon payment. That's 100 plus par minus price. So 1,000 minus 875 divided by number of years to maturity, 10 over 0.6 times the price, 875 plus 0.4 times par, 1,000. Okay, so 1,000 minus 875 is 125 divided by 10, 12.5 plus 100, 112.5, 0.6, 525 plus 925. So you get 12, 0 point, sorry, 1, 2, let's say 122 if you round it, which is 12.2%. But the question says that we should find the after-tax cost of debt if the tax is 30%. So after-tax cost of debt is the cost of debt into bracket 1 minus the tax rate. So it will be 0.122, that's 12.2% bracket 1 minus the tax rate is 30%. So you get 0.0854. It's 8.54%. %8.54%. B. What if the price was rather, what if the price is rather 1,250? Let me give her some 5 minutes and let's compute. I've changed the price to, so everything in the formula will remain the same, but 875 will be 1,250, okay? So give me cost of debt and then after tax cost of debt. So resolve everything, but now we are using a price of 1,250 instead of 875. Let me give you some 5 minutes, solve and then type the answer for me. Let's do it together. Let's do it together. So you have 100 plus 1,000 minus 1,250 divided by 10 all over 0.6 times the price 1,250 plus 0.4 times 1,000. That's all. When you punch your numerator, to be 1,000 minus 1,250 divided by 10, you get minus 25. So 100 plus minus 25 is like saying 100 minus 25. The numerator is 75. And then the denominator is 1150. So I'm getting 0.065. That is 6.5%. I'm getting 6.5%. I am getting 6.5%. And then the after tax cost of debt will be 1 minus tax. So sorry. So the cost of debt was 0.065. And then the tax rate is 30%, so 1 minus 0.3. 1 minus 0.3. So the final answer is 4.55%. Okay, good. So let's wrap up with valuation of bonds, and we'll come to valuation of shares and all this. And then finally, we come to weighted average cost of capital. Oh, sorry, I said valuation. Sorry, I mean cost of. Let's wrap up with cost of debt. Okay, let's wrap up with cost of debt by establishing certain facts. I'm going to show you certain facts about cost of debt, and it's so interesting. It's so interesting. So interesting. All right. Now, this question originally, okay, a moment. Yeah, so I'm going to show you a certain relationship, and it's so interesting. Look at it. When coupon, look at it. Now, let me talk about the relationships before I show you. Right? So 3 lessons we learned. Number 1, anytime the coupon interest rate is greater than cost of debt, the bond will be bought at a premium. Number 2, anytime the coupon interest rate is less than cost of debt, the bond will be bought at a discount. Number 3, anytime the coupon interest rate is same as cost of debt, the bond will be bought at par. What do I mean by premium? Premium means that price is greater than par. Discount means that price is less than par. At par means that price is equal to par. And these things, they make finance logic. It's just finance logic. Let's go through them again. Now, remember that I told you that coupon interest rate is whatever is agreed. Okay, coupon interest rate is whatever is agreed between the coupon interest rate is whatever is agreed between the bond issuer and the bond holder. It doesn't mean that that is the actual interest rate on the market. It doesn't mean that. So the cost of debt or the yield to maturity is what people will require on a similar investment in a market. But because it's just between the two of us, we are going with our own rate called coupon rates. Now, if the coupon rate is greater than what the market is offering, okay, it means that when I buy the bond, I will be over enjoying. Because if I go to the market, I don't get that rebate. If I buy from a firm, they are giving me that rate. That means that I must buy, because I'm over enjoying, I must buy the bond expensive. And this also means that when that happens, the price will be greater than value. You must buy it at a price which is bigger than how much you redeem it or how much the par value is offering. So we say that you buy it at a premium. When you buy something at a price bigger than its par value, you are buying it at a premium because you are over enjoying. Because you are over enjoying. Number two, anytime the coupon interest rate, as in any time the rate we have agreed upon, is less than what the market will offer me, it means that it will hurt me, like it will go against me. Why didn't I go to the market? But I'm coming to you. Because you are giving me a coupon interest rate less than what the market is offering me. Less than the cost of debt or less than the yield to maturity. So in that case, I must not buy the bond at a price. So I must buy it at a discount. So always, anytime the coupon interest rate is less than the cost of debt, the bond will be bought at a discount, as in the price will be less than the par value. And anytime the coupon interest rate is the same as the cost of debt or the yield to maturity or what the market is offering, you buy it at the par value. So you buy it at par, the price will be the same as par. So those are the relationships. Let's see. The coupon interest rate was 10%, okay? All right. The price is 875. Par is 1,000. So price is 875, par is 1,000, means that you are buying it at what? A discount. You are buying it at a discount. Because price is 875, par is 1,000. You are buying it at a discount. And the implication, the reason why you are buying it at a discount is that the coupon interest rate is lesser than what the market is offering. So let's see what the market is offering. The market is offering 12.2. Okay, not after tax, so like the normal market. Let's ignore tax. It is offering 12.2. And the firm is giving you 10% coupon. So because of that, that's why you are buying the thing at a discount. So anytime the coupon is less than the yield to maturity, when you find the price, you realize that the price is always lesser than the par. Let's look at the second scenario. I said, what if the price is 1,250? So here the price exceeds the par. So when you calculate it, you had the yield to maturity be what? 6.5? Yeah, 6.5%. What it tells us is that anytime you are buying, anytime the price is greater than the par, technically, the coupon rate should also be greater than the yield to maturity because you'll be over enjoying. That's why you are buying the thing at premium. Okay. And later you can try it. Later, you can find the price, or later you can find the yield to maturity if the price is also 1,000. So let's assume price is 1,000, par is 1,000. Okay, price is 1,000, par is 1,000. When you do it later, you realize that you get the yield to maturity to be 10%, the same as the coupon rate. So these are certain things about bonds we should know, all right? These are certain things about bonds. Okay. So next, we are going to talk about finding the cost of preference shares.